Let me start with a number that affects millions of Australians directly. 4.10%. That's Australia's official cash rate right now. And in March 2026, the Reserve Bank of Australia raised it again, adding another 25 basis points at exactly the moment when millions of Australians were already struggling with the cost of living. Groceries are more expensive, rent is at record highs, and now your mortgage repayments just went up too. Today, we're going to break down exactly what the RBA does, why they raised rates when so many Australians are already under financial pressure, and what the next rate decision coming up in just a few weeks on May 4th and 5 could mean for your wallet. First, let's quickly explain what the cash rate actually is, because it's one of those terms that gets thrown around constantly, but not everyone knows exactly what it means. The Reserve Bank of Australia sets what's called the cash rate. This is the interest rate that banks charge each other for overnight loans. It sounds very technical and far away from everyday life, but here's why it matters. When the RBA raises the cash rate, banks pass that increase on to their customers. That means higher interest on home loans, higher repayments for anyone with a mortgage, and because landlords with investment properties also have mortgages, higher rates often get passed on to renters too through rent increases. On the flip side, when rates go up, interest on savings accounts also increases. So if you're a saver, higher rates are actually good news. If you're a borrower, not so much. The RBA's official job is to keep inflation within a target band of 2 to 3% annually. When prices are rising too fast, when inflation is too high, the RBA raises rates to cool spending. The theory is if borrowing is more expensive, people spend less, demand drops, and prices stabilize. That theory works in a textbook. In the real world, when a family is already skipping meals to cover rent, being told their mortgage is going up feels less like economic management and more like punishment. So why did the RBA raise rates in March 2026? The short answer is inflation is still too high. Australia's Consumer Price Index, which measures the change in prices across a basket of everyday goods and services, sat at 3.7% annually as of February 2026. That's above the RBA's target band, which means, in the RBA's view, the economy is still running too hot. The problem is that this inflation isn't being driven by Australians splurging on luxury goods. It's being driven by the basics: housing costs, food, energy. Things people can't simply choose not to buy. Housing costs rose 5.5% over the past year. Electricity prices jumped 21.5% as state-based rebates were wound back. Food prices rose 3.5%. Meat went up nearly 4.5%. Fruit and vegetables up 4%. And yet the RBA's response to people struggling to afford these basics is to make their borrowing more expensive. Critics argue this is a blunt instrument, being applied to a very specific kind of inflation. Raising rates doesn't build more houses. It doesn't lower electricity prices. It doesn't fix global supply chains. What it does do is reduce how much people can borrow, slow the property market, and in theory, gradually bring demand back into balance with supply. Here's what the rate rise actually means. In dollar terms for ordinary Australians, if you have a $500,000 mortgage on a variable rate, which most Australian home loans are, a 0.25% rate increase adds roughly $70 to $80 a month to your repayments. That doesn't sound huge, but the March rise didn't happen in isolation. Since the RBA began hiking rates in 2022, the cash rate has gone from near zero to 4.10%. That's a cumulative increase of about 4 percentage points. On that same $500,000 mortgage, the total increase in monthly repayments since 2022 is now somewhere between $1,000 and $1,200 a month. Every month, compared to what you were paying 3 years ago. That is an enormous hit to household budgets. And it lands hardest on people who bought homes at the peak of the market in 2021 and 2022, when interest rates were near zero, and borrowing was cheap, and who are now repaying those loans at rates that were unimaginable when they signed the papers. For renters, the picture is almost as bad. Vacancy rates across every Australian capital city are sitting at about 1.6%, which analysts describe as critically tight. The median weekly rent across combined capitals is now $665 a week, or roughly $2,900 a month. And landlords, facing higher mortgage costs from rate rises, have been passing those costs on in the form of rent increases. The Australian Council of Social Service summed it up pretty starkly this week. People on the lowest incomes, they said, are being forced to skip meals, go without critical medication, or sleep in their cars, because their payments and incomes are simply not keeping pace with what things cost. Now who is feeling this the hardest? Data from the Australian Bureau of Statistics tells us that pensioner and beneficiary households recorded the largest rise in living costs over the past year, up 4.1 to 4.2%. These are people whose incomes are largely fixed. They can't ask for a pay rise. They can't work more hours. When prices go up and rates go up, they simply have less money to live on. Employee households, people earning wages, recorded the smallest annual increase in living costs, at 2.3%. That's because wage growth, while modest, has provided some buffer. But even for workers, wages have not kept pace with the compounding effect of higher mortgage costs, higher rents, higher groceries, and higher energy bills, all hitting simultaneously. The generation being hit most broadly by all of this is young Australians in their 20s and 30s. They're either renting at record prices, or they bought at the peak of the market, and are now managing massive mortgage repayments. They're also the ones most likely to have done the right thing. Worked hard, saved up, bought a home, and found themselves on the wrong side of an interest rate cycle they had no control over. So what happens next? And why does the May 4th and 5 RBA meeting matter so much? The RBA board meets every 6 weeks or so to review the cash rate. The next decision is on May 4th and 5. And financial markets and economists are divided on what happens. The case for holding rates steady or even cutting is that economic activity is slowing, consumer spending is weak, business confidence has fallen sharply. The unemployment rate, while still relatively low, is starting to tick up. And the global economic outlook, with the Iran war adding inflationary pressure from fuel costs, is deeply uncertain. The case for another rate rise is that inflation is still outside the target band. The labor market is tighter than expected. Housing prices nationally rose 9.3% over the past year, which suggests demand is still running hot, even if it's slowing in Sydney and Melbourne. And the RBA is worried that if it eases too soon, inflation could rebound. Most economists are currently leaning toward a hold at May, meaning no change. But nobody is ruling out another increase. And almost nobody is predicting a cut anytime soon. What that means practically is that Australian mortgage holders and renters should not expect relief in the near term. The pain is likely to continue for at least several more months. Here's the big picture question underneath all of this. Australia's cost of living crisis has multiple causes. Housing undersupply, global inflation, energy market disruptions, population growth outpacing infrastructure. These are complex, structural problems. They take years to fix. The interest rate tool is one of the few levers the RBA can pull. But it's a blunt instrument. It can slow down an overheating economy, but it can't build houses. It can't grow food. It can't fix a global energy system disrupted by war. And when you raise rates during a period when ordinary people are already choosing between rent and groceries, the economic logic is technically sound, but the human impact is brutal. Australia is heading toward a federal election later this year, and the cost of living, housing, mortgages, rent, groceries, energy is shaping up to be the single most important issue on the ballot. How politicians respond to this moment, and whether their proposals genuinely address the structural causes, rather than just the symptoms, will matter enormously for millions of Australian households. So has the rate rise hit you directly? Are you on a variable mortgage? Have you seen your rent go up? I'd genuinely love to know what this looks like from where you're sitting. Drop it in the comments. The more people share their actual experience, the better we all understand what's really going on out there. Like and subscribe for more Australian news broken down simply. See you next time.